Today we'll explore 4 of the most common misconceptions about mortgage eligibility to provide clarity to help you better understand what lenders are looking for and how you can increase your chances of approval. So number 1 is that you may need a perfect credit score. And this is one of the most widespread myths that you hear about mortgages, is that you need a perfect credit score to qualify for a mortgage. Many lenders offer mortgages to individuals with less than perfect credit scores. Additional factors such as your income, your debt to income ratio and the size of your deposit can all help compensate for a lower credit score. Less than perfect credit score does not mean you can't get a mortgage. It just means that you may need to explore specific mortgage lenders or products designed for individuals with varying credit histories. The second misconception is that you must have a large deposit. And for many prospective homeowners, they're under the impression that they must put at least a 10% deposit down to qualify for a mortgage. And this misconception can prevent people from even considering home ownership, as saving for 10% deposit of a home's value can feel like a challenge that is insurmountable. Now, whilst the 10% deposit was once the standard, it's no longer a strict requirement for many mortgage products. There are a variety of low deposit mortgage options available to people, such as 95% allows buyers to purchase a home with just a 5% deposit. Some lenders offer special schemes where you can potentially purchase with no or very low deposit, and shared ownership schemes allow you to purchase a portion of the property with a smaller deposit and rent the rest. Thirdly, people consider that a high salary guarantees mortgage approval. Whilst that may be a case that high income qualifies them for a mortgage, the mortgage lenders are not only concerned about salary levels when assessing eligibility. The overall affordability assessment looks at several aspects of your financial situation. Firstly, they might look at debt to income. Lenders will also consider your credit score, so they'll look at your credit history to assess whether you have a track record of managing debt responsibly. They'll also look at the size of the deposit, and that's another critical consideration for the mortgage lender. A larger deposit means a smaller loan and a lower risk from the lender's perspective. And when considering your income, they'll also look at your job stability. So lenders will assess your job stability and how consistent your income is, especially if you're self-employed or have a non-traditional income stream. So in essence, a high salary loan doesn't guarantee mortgage approval. And the fourth misconception that many people believe is that you've been turned down for a mortgage by one lender, then you won't be able to secure a mortgage from any other lender. And whilst a mortgage rejection can be disheartening, it doesn't mean that other lenders will automatically turn you down. Lenders each have their own different criteria, and what one lender might view as a risk, another may see as manageable. If you've been declined, we'd recommend speaking to a broker. A broker can help you understand why you were declined and can shop around with multiple lenders to find one that's more suitable for your circumstances.